Good morning, everyone, and welcome to Weekly Profit Talk. Uh, the topic for this week is Quarterly Taxes Simplified, How Doctors Can Avoid IRS Penalties in 2025. Now, I know this is going to be a very interesting topic for people that have had some kind of tax difficulty in the past. And I want to reach out specifically to the people that believe that they're paying more tax than they should be. This is one of the reasons why this happens. And so let's cover this. Why don't we? But before I do, Weekly Profit Talk, like the name implies, is a weekly program. And I jump on here and talk to you on Facebook, LinkedIn, or YouTube. All three of which, by the way, has a comment section. If you ever have any questions about anything at all, pop it right into the chat. Matter of fact, if you're live and watching this now, there's even a way that you can ask questions. Hopefully it doesn't distract me from the little bit of information I have to impart with you here today. But this is how you can avoid these IRS penalties. And I think this is very important information. So without any further ado, let's go ahead and get started. So first thing, if you look at the first sentence here, paying as you go versus all at once when you file. You can probably think of one or two reasons why that's not a great idea without any help from me at all. Let's say, for example, you're going to owe about $40,000 in tax. Would you rather be paying for that 4 times a year and getting that cleaned up as you go? Or just blow the whole thing off, don't worry about it, and just pay them when you file your Form 1040? Well, I'm going to tell you that there's a couple of huge reasons why you should not do that. Plus my own little opinion. I believe that there's a room in the mind, and it feels cluttered when these things kind of back up on you, even subconsciously, even if you're not thinking about them and you drive it to the back. After all, you're busy, and you didn't go to medical school and through residency for 10 to 12 years to learn how to be a business person. So we understand. That's why we're here to help. So, but if you pay all at once when you file, one thing is, let's say, for example, you're going to owe that $40,000. Did you remember to plan for it? You didn't? Oh, what do you do then? Rob a savings account? Heaven forbid, never, ever, ever go into your IRA tax-deferred retirement because that will cost you all kinds of extra money. Plus, they penalize those withdrawals as well. So your other solution is to get on an installment agreement, and you're actually paying for your taxes over time, but at the back end with interest. And plus, you're going to also pay penalties on that amount as well because you didn't make estimated tax payments in the first place. As it says, if you make over $1,000 in back up. If you make a sufficient amount of income to where you will owe over $1,000 in a single tax year, you are required by IRS code to make these payments. If you don't, they don't stand over you with a cattle prod or a whip. What they do instead is they hit you on the wallet later, and that is their enforcement tool. So it's avoidable, and let's talk about that some more. There is an attachment. You may have seen this on one of your prior tax returns. Open one up. Take a look. If you've ever seen Form 2210 attached to your return, it's going to be past all the Schedule 1, 2, 3 stuff. And if you have anything else that goes in order, such as Schedule C, Schedule E, but it's buried in there somewhere. Form 2210 is the IRS charging you more money. Now, any decent accountant will go ahead and run that form. Their software basically do it. But if you have your eye on the ball, you don't just let artificial intelligence do all your thinking for you as an accountant. We certainly don't here. But this is calculated based on how much you did or did not pay each quarter. And those quarters end in the middle of April, June, September, and January, by the way. And Form 2210 is actually it's a couple 3 pages long. It calculates each of those quarters in a mathematical algorithm called annualization. Now, see, we here at Owings LLC, we actually annualize payments for people that have. I just realized that part of my slide's not appearing here. I'm going to stop sharing for a second. Sorry, I'll go ahead and I'll keep talking while I'm doing this. Okay, so yeah. I beg your pardon. Let me see if this fixes it. I appreciate your patience. Thanks. Okay, so let's see. Oh, no, that's just not going to work. I'm sorry, this is ridiculous. But it's bothering me. So let me get this done. Okay. All right. Okay. Let's move on. Okay. I will tell you what it's supposed to say here at the end. I apologize for this. I really am going to fix this. And the best way to do that is let's just make that a little bit smaller so it all fits in the window. I appreciate this, and thanks for hanging in there with me. So let's go ahead and do that and that. Okay, it's just not going to fix itself. Let's go ahead and go back. I apologize. There's a minute out of your life you can't get back. So thank you for hanging in there with me. In any event, we were talking about the annualization of penalties. There is also something that I need to be able to share with you here at this point, and that is that not only do they charge you underpayment penalties for each quarter that you don't pay enough or don't pay anything at all, but there is also an accounting principle, and if your accountant's on the ball and cares about your fiscal health and strength and the growth of your company, then they should let you know that you basically want to pay for your expenses in the same month or quarter that the money that you made to create the expense occurs. So they actually call that matching. And it's critical that you do that. It's not only to keep that room in your mind clean, but it's also to put hundreds or thousands of dollars back in your own pocket. So let me see. Do we have... That was the last slide anyway. So sorry. Let's get that fixed. Okay. Now I'm just doing this in front of you. Isn't this fun? Okay, here we go. So now here's the simplest way to do this. If you are just determined to basically pay somebody to do your taxes in February, March, whatever, and basically ignore all tax planning. And this is the fifth grade simple version of this. The simplest calculation is that you want to take your expected annual income and multiply it by your effective tax rate. Now, let's say, for example, and I'm going to use a very conservative amount of 18% effective tax rate. That's basically calculated by the tax you pay divided into taxable income, and taxable income is after you get all your deductions off of it. Your standard deduction, if you're running a S corporation with your practice by now, then your flow through income becomes net income or business income on your 1040, and you do get to write off 20% of that. So I kind of put together a little example. Let's say you're taking $150,000 in salary from a practice that, after that expense to pay yourself as well as all your other overheads, makes an additional $150,000 in net income. So in effect, you've got $300,000 that you're being taxed on. The salary part, of course, is going to have withholding if it's set up correctly. So you'll have some money paid in. You'll have your standard deduction, assuming you're married, that's going to be around $30,000, and the qualified business income deduction. So with that example, that $300,000, let's say I'm going to reduce that by about $70,000 for your salary reduction, withholding, as well as the other two deductions. So you're paying tax on $230,000, even at a very conservative 18%. That's over $41,000. So you can see that you're going to want to pay in about $10,000 a quarter, maybe even $10,300, for example, to get to that 41. I would be paying $10,200 personally. Just you want to get a hair under that, but as close as possible. So expected annual income times effective tax rate. you're going to come up with $41,000, divide by 4, and that is $10,250 technically. You can round down a little bit. We'll allow that because, again, remember, you only have to pay to within $1,000 what you owe. This only works well if your income is basically always the same. You've got your full roster of patients. Your rates haven't gone up. You're not offering any new services or products. And you can basically count on making about the same amount of money every month. That's nice if you can do it, but if you're an up-and-coming physician, you're probably thinking about expansion and perhaps being able to sell your practice in the next 20 years, grow your practice, and actually mentor some people and have some additional clinicians on your staff. So we just talked about annualization. We actually do that at the front end as our calculation for every one of our clients. And this is a thing which there's no shame in asking for professional help with this sort of thing. If you think about how much you bill one of your patients, and then multiply the amount of time that you spend on this yourself by the number of hours it takes you to do it, you're losing that much money. You're actually probably going to return on investment by hiring a happy professional that cares about your fiscal situation. So with that, and I mentioned Form 2210, actually, and I do apologize. I've moved ahead to the last slide. Let's go ahead, and I am going to shrink that so you can actually see its entire. Oh, I didn't get it all in. All right, well, that's all that needed to say. So why pay hundreds or even thousands of dollars? You don't have to. Yes, it can be that much. Imagine, if you will, that you underpaid $40,000 in tax. You're going to have a whopping underpayment penalty. It will appear down next to the amount you owe. I don't remember the line number. And the 1040 changes every year, so fortunately I don't have to. But there's a place for your refund, and that's for your W-2 filers, wage earners. But you'll have an amount that you owe down at the bottom, and it's going to include your taxable amount from further up the column, plus an underpayment penalty, which will appear at the bottom, and that came from Form 2210. So how you can avoid this? Well, I've given you two things you can do. One is do the stupid simple math thing. And if you do have rock steady income, actually, if you're using a professional tax software or going to a once a year guy, you might even have estimated tax payment vouchers in your paperwork. Use those. It's better than doing nothing. Okay. So that is plan A. And plan B, of course, is reach out and let's talk about how we make doctors wealthier by paying as little tax each of those estimated tax payment periods as possible. We annualize your payments. So if you have a down quarter, you're not paying more than you should. You know, you don't want to pay $10,000 of tax on what should have been $7,000 based on, you know, a down period. So we ensure that you're not overpaying the IRS as well, which has its own issues. Mainly, the United States Treasury is stripping you of the earning power of your own money. If you've got like an $8,000 or $10,000 refund coming back to you, wrong answer. It's a terrible thing to do because that means that $8,000 or $10,000 that could have been earning these days high yield savings is somewhere between 3.5, 4.5%. But ROI on something like a brokerage account could be, and ideally they should be able to get you 10% or more. So you lose that by paying it all into the IRS and then getting it back when you file. They love when you do that, by the way. And here's another nasty trick I'm going to add to this. If you fail to file for your refunds for 3 years, you lose them infinitely. Now, I know you're not going to do that because that is financial suicide, but it's just a thing. The IRS is not your friend. They don't stand over you and tell you what to do. They punish you by hitting you in the wallet later. I've shared with you how to avoid that, and I hope this has been helpful for you. So I enjoy talking about this, and I'm going to continue to speak on this and many other tax savings themes in the near future. We do this every Wednesday at 8:30 Mountain Time. That is 7:30 if you're in LA. And by the way, I hope the fires are getting better there. And 10:30 out on the East Coast. So every single Wednesday, we will be back on the 22nd of January. And we're probably going to end up talking about subcontractors because we got 1099 season coming. So last thing, let me leave you on this note. Today is January 15th. If you have not made an estimated tax payment for your final quarter of 2024, you will have until midnight to go on IRS Direct Pay. I don't know the website, but you don't need to. Just type that into Google or your other favorite browser. Hit enter, choose the irs.gov website that comes up at the top. Never, ever pay to make a payment with a private third party. If you open a website and there's a blue make a payment button and the official IRS seal, rock and roll, get it done. Okay. Today's the day. You will have until midnight for it to be time stamped. I would jump on that as soon as you get home from work. So with that, hope you have an amazing day. And if you do have a chance, do something randomly kind for a stranger today. With that, so long, and we will see you next week.